Hey, welcome everyone. Welcome. So we are going to deep dive into credit issues. So even if you have a credit issue, it's still possible for you to get approved. So what do I mean? Life happens, lives, right? And people have issues that happen such as bankruptcies, foreclosures, evictions, um, repossessions, collections. So they have a lot of issues that could potentially happen to them on their credit. But guess what? It's not the end of the world, right? So you can still get approved for a mortgage even if you don't have perfect credit. Um, is there some work involved? Yes. Like anything worth having, there's work involved. There's things that you need to do, things that you need to have. However, you can get approved for a mortgage. The worst thing that you can have is a foreclosure, right? But guess what? Even after you've had a foreclosure, you have the ability to purchase a home again. How so? Because there's time frames that are put in place where if you meet those time frames or have surpassed the time frames, you're allowed to purchase again. So with FHA, if you've had a foreclosure, then after 3 years of not when it was foreclosed on, but take this note, 3 years after you have your mortgage insurance has paid off the creditor, then you're able to purchase a home. So the worst thing that you could have is the foreclosure in terms of housing. And after 3 years, you can buy again. So that does not stop you from purchasing a home foreclosure. Let's say you did bankruptcy. With bankruptcy, after 2 years and a day, if it's chapter 7 bankruptcy, you can apply again. After two years and a day after your bankruptcy has been discharged, you have the ability to apply again for a mortgage. Are you going to be looked at differently and maybe scrutinized a little bit? Yeah, you are, because you had a major credit event hit. But what you definitely want to do is, if you currently in bankruptcy or you have filed bankruptcy, you want to make sure you reestablish your credit. And the other thing is, you want to make sure that you pay attention to your credit. You don't want to have any type of collections or late payments that come on your credit after you've already had a bankruptcy. So, guys, if you just hopped on, we are talking about if you've had credit issues or have credit issues, you can still get approved for a mortgage. We've talked about foreclosures so far. If you're watching this, and you're new to my channel, hit the notification button and possibly subscribe so you can get notified when I come on and do lives or when I produce new videos. So let's take bankruptcy. If you have Chapter 13 bankruptcy and you want to apply for a home while you're actually in the bankruptcy, you can do it. You just need 12 on time payments for the bankruptcy, and then we can pre-approve you. Now, there's going to be something called manual underwrite. What a manual underwrite is, we are going to manually underwrite your file, and there's going to be a couple different steps that you need to take, right? The first additional step is, do you have a 12-month history of paying your rent on time? Why do we look at that? Because your rent is the highest payment that you're typically going to be paying, as close to your mortgage as possible, as close to a mortgage as possible. So we're going to look at that and see if you're paying on time. And then we're also going to make sure that after you pay pay your down payment and closing costs, which are going to have to come from you, that you have the ability to have 1 or 2 months reserves left over to show that you have money. If you can do that and you're inside of your bankruptcy and you can provide us 12 months of on time payments in your bankruptcy, you can qualify without a problem at all. Now let me recap that. Once you're pre-approved through us and you submit an offer in for a contract and your contract gets accepted, then you have to take the contract. I give you something called an estimated fee sheet, and you have to have estimated fee sheet, and then you submit that to your bankruptcy trustee. Hold on, let me get my sound right. You have to get you have to get an approval from your trustee from your bankruptcy. What they're going to look at is, are you incurring too much debt or more debt than you need? Do you have the money set aside? And does this fit into your price range? So with that being said, that's why we have the guidelines we have for FHA. So we're not going to allow for you to borrow we're not going to allow for you to utilize the same amount of income that you would use if you didn't have bankruptcy, no matter what your score is, because we want to make sure that we don't put you back into a situation where your house gets foreclosed on or you have to try to file another form of bankruptcy again. So in the meantime, while you're in the bankruptcy, we're going to do our best not to have you extend too much credit so that you put yourself back in that situation as well. The next thing is with that, you can't participate in down payment assistance programs with a Chapter 13 bankruptcy while you're still in it because of the manual underwrite. Now, let's say you file Chapter 13 bankruptcy and you have been discharged for 2 years. Once you've been discharged for 2 years from your Chapter 13 bankruptcy, you can get approved with a desktop underwriting system, as well as at that point, you will have the ability to utilize the down payment assistance programs. So again, bankruptcy, it stays on your credit. We're going to see it. However, you still have the ability to purchase a home, even if you have filed for bankruptcy. So, don't let those things stop you. So the next thing is an eviction. So listen to this. We don't care if you've been evicted from a property. What we do care is if the debt is still on your credit. If the debt is on your credit and you're not making payment arrangements, then guess what? We can set up a payment arrangement, or have you set up a payment arrangement, make 3 on-time payments, and we can get you qualified for a mortgage. That's whether it is a collection or if it's a judgment. Now, to take you a little further, if it's a collection and you aren't making payments on it, however, we can use 5% of the balance and add that to your debt to income ratio, and then use that to see how much you can qualify for. So again, we don't care about the eviction. We don't care if you've been evicted. We don't care if it was 1 year or 5 years. What we do care is this person in position to purchase a home? When you look at rentals in the market that I'm in the markets that I've seen, they want 3 times the amount of the rent. So average rent in Atlanta area is like $2,000, $2,500. So in order to rent, you need to make $7,500 a month to rent an apartment or rent a house. If you're making $7,500 a month, you probably can purchase a home. So take that into consideration. I've seen people say it's easier to purchase a home than find a rental because of what they're looking for. They want you to have great credit or good credit. They want you to have make 3 times the amount of the rent. And then in some cases nowadays, they want you to have first month's rent and 2 months of security deposit. That $7,500 could potentially get you into a house. If you're using down payment assistance program and you add a couple $1,000, depending on your pricing point, you can buy a house. So again, you've had a foreclosure, we can get you approved. You've had a bankruptcy, Chapter 7 or Chapter 13, we can get you approved. You got an eviction, you've been kicked out of your apartment. Life is lifing. Life is happening to you. If we can get around that, whether it's a judgment or a lien, we can get you approved. And guess what? The fourth thing, collections. So the rule with collections is if it is non-medical, let's say it's AT&T or Verizon or whatever, if it is over $2,000, then we have to do a few things, right? One of a few things. We can get a payment arrangement, right? So the payment arrangement can be for X amount of dollars. We need to make 3 on-time payments. The next step is we can use 5% of the balance, right? Use 5% of the balance and count that into your debt to income ratio. Or we could take the money and pay off one of the bills and allow for that to be under $2,000. And then we don't have to touch the rest of them or add those things to your debt to income ratio. Well, hey, Kevin, I've got medical collections. We don't even count medical collections. Hear me, we don't count medical collections. Now, will medical collections affect your credit? It's possible, right? But then we'll look at it, we'll run it through the simulator and see if we can do a pay for deletion and get that off to help increase your score. My goal as a lender, and I can speak this for some fellow lenders, is to get you into a home as efficiently as possible. Who has perfect credit? There's more people with bad credit than perfect credit. And also just remember, credit is a snapshot of where you are at the moment. It's not who you are, right? So again, we can help you get approved if you have foreclosure. We can get you approved if you've been through a bankruptcy, Chapter 7 or 13. We can get you approved if you're currently in a Chapter 13 bankruptcy. We can get you approved if you had evictions, and we can get you approved if you had collections. So aside from your credit score, we can any situation we can get you approved for. We want to make sure that it's properly set up. There is no getting around certain situations. And as much as we all have not excuses, we have reasonings for what happened, the underwriter doesn't really care about what happened, right? What we and the underwriter care about is, do we have an explanation or a solution that meets the guidelines for either FHA, USDA, VA, or conventional that will say, okay, we can accept it if we have this or that documentation. So guys, if you just joined, we are talking about credit issues and getting approved. Do me a huge favor, hit the notification button and subscribe to the channel. You'll be notified every time I go live. I'm starting to be more active in my community, asking my community what they want to know about mortgages or how I can help them get approved. In some of those situations, you can, so example, if it's a judgment or a lien, that doesn't stop you. It doesn't stop you. We just need to set the file up properly. 3 on-time payments. The 3 on-time payments cannot be in the same month. So if your bill is $100 a month that you set up a payment arrangement, you cannot pay $300 and say you made 3 on-time payments. What we want to do is make sure, what we want to do is make sure that those payments are made separately, and we can account for the times. So example, if you made a payment in October, November, December, as long as that third payment is made before we close and we have the third payment made, and then we can go into underwriting, no problem at all. Well, Kevin, guess what? I got a tax lien. We can get you approved. Yep. You have a tax lien. We can get you approved. Same thing. What you need to do is set up a payment arrangement with the IRS. If it's a federal lien, set up a payment arrangement with the IRS, make 3 on-time payments, and then as long as that third payment is made before we go into final underwriting and go to closing, we can get you approved. I just did it. Just helped the young lady who had IRS payments. She made the payment plan, set the payment plans up, made her payments, and she was good to go. Well, Kevin, I owe the IRS money. If it is not a lien or a judgment, what you can do is set up a payment arrangement, and all you have to do is make one payment. One payment. If you make one payment, we send it back to underwriting, we get the loan approved, you're good to go. So you don't necessarily need to make 3 payments. You can make one payment if it is not a lien or a judgment, and we can get you approved. So again, every major credit issue that you have, they have guidelines set to where if you can make it happen, or you can meet their standards of what they want, we can do it. Bankruptcy, foreclosure, eviction, tax lien, state tax liens, judgments, collections, we can get you approved. It takes time, it takes patience, it takes some work on your side, but we can do it for sure. Hey guys, definitely don't allow for those credit issues to mess you up. And before you do anything, I would suggest you reach out to a lender and sit down and let them pull your credit and see if there's anything that you see what you need to do. Although I am giving you specific information that needs to be done, and you can do those tactics, there still may be some things that you may need to do, depending on how often you look at your credit, or how astute you are with what's going on with your credit, how knowledgeable you are with your credit. So I would say reach out to a lender to find out, hey, this is what's going on with my credit, and I'd like to purchase a home. What can I do? You might have all of the above. You might have bankruptcies, tax returns, foreclosure, collections, judgments, evictions, and guess what? You can have them all and still qualify. Hey, Kevin, guess what? I got my car repoed. You can get approved. You can get approved. Depending on how it reads on your credit too. So some repossessions they've happened, and depending on who the lender was, they've charged them off. If it's a repossession and it says charged off, we don't have to count that against you. Now, what does count against you is if that charge off has been sent to a collection company or attorney's office to collect on that debt, and it's reporting to your credit, then yeah. But again, we can get over that. Let's say you have a repossession, it's charged off. You owe $10,000 and it's been sent to a collection company. If you don't have the ability to pay for that collection, then we set up a payment arrangement. As simple as that. Make 3 on-time payments and you can purchase a home. Well, Kevin, I don't want to make the payment. It was for my ex-wife. It was for my husband, and I'm not paying for that car for them. It was in my name. Cool. You don't have to. We can use 5% of that debt and 5% of that balance and roll it into your monthly debt. And then you just qualify based off of that amount. And when we use 5%, you don't have to make payments. We just use that debt. So if they come after you and you do eventually have some type of payment arrangement, then we've already counted it into your debt to income ratio to show that you can pay. We don't have no excuses, guys. We don't have any excuses. We don't, no excuses at all. Hey, Kevin, I've defaulted on my student loan debt. You can still qualify. You reach out to your student loan servicer. You get your student loans back into good standings, whether it's a rehabilitation program or if they've enacted that bill they passed where everybody gets a fresh start with their student loans. You get them back into good standings and you set up some type of payment arrangement, an IBR, income-based repayment plan. We can get you qualified. Well, the student loans aren't showing on my credit. We're going to run something called CAVERS. CAVERS is a government system that pulls up all debt. Even if you somehow got it not to report on your credit, but it's still, you still owe it, we can pull it on CAVERS. And if so, that's fine. That's not the end of the world. Now we need to find a solution on how to get it out of CAVERS and to get you on a payment plan with your student loan servicer so that you can become a homeowner. So to recap, we've got student loan debt that's defaulted. You can get approved. Judgments, liens, you can get approved. I've been evicted from an apartment. I've been evicted from 2 apartments. You can get approved. I've been foreclosed on a house before. Heck, I've been foreclosed on 2 houses. Can I get approved? You can still get approved. I have IRS debt. Let's set up a payment arrangement and get the IRS what they need. And let's set up the file the way the underwriter wants it. You can still get approved. Any major credit setback that you have had, you still have the ability to get approved. Your lender needs to know what he or she is doing, but you can get approved. So I've had this question. Well, what if I do credit repair and try to get it removed and dispute it? It could happen, but I think it's a faster solution by doing the regular guidelines. So I'm a fan of credit repair when needed, but what I just told you, those things are faster solutions than probably credit repair. So you definitely want to make sure that you sit down with a lender, let them pull your credit, let them run CAVERS, and look at your credit and give you a game plan on what you need to do. So with that being said, guys, if you're just chiming in, do me a huge favor, subscribe to my channel, give me a thumbs up. I definitely appreciate it. Appreciate you guys showing the love. And now I am going to take some questions. All right, I'm gonna start with Miss Barbara. Who is offering a 40-year mortgage? No one. The 40-year mortgage is for people who currently own homes that are in default, and it was a COVID related event to their default. So the government is allowing for them to do a modification of their loan and stretch it out over 40 years. So typically they're going to do a couple things. They're going to add the debt on the back end of the loan. They could potentially lower the interest rate so that the payments are more affordable. They could also ask for a lump sum of money and then put the additional money on the back end of the loan. Or they could put it on the back end of the loan, and depending on how far back you are, they could make your payments higher for a few months, maybe a year, and allow for you to catch up. But the 40-year mortgage right now is only for people who need modifications on defaulted debt. That's where the 40-year mortgages are. There's a lot of misinformation, but hopefully I cleared that up for you, Miss Barber. Good evening, Miss Eunice. Good evening. Thank you, Noble. I appreciate you, brother. Rick H. What collections would cause a decline on the AUS? And what reserve funds do I need to avoid a AUS decline? Great question. So, listen to this. When you're applying for a mortgage, there are three major factors that we're looking at. We're looking at credit score, we're looking at debt to income ratio, and we're looking at assets. Those are the three major things we're looking at. If you have all three, you're going to be in a great position to get approved, AUS approval. If you have a low credit score, but you've got a low DTI and great assets, then those assets and DTI compensate for the low credit score. If you got a high credit score, high DTI, but great assets, that can compensate for that high DTI. But if you have a low credit score, high DTI, and you don't have any money, you're most likely not going to get approved or not get approved for as much as you need. Rick, everyone is different. Depends on your situation. Typically, if funds are required, it's going to be 1 to 2 months reserves. Sometimes 3 months reserves. But again, it's a situational. So your lender can tell you by looking at it and running your credit, because you might need 1 month's reserve and somebody else may need 3. Hopefully that answers your question, brother. Congratulations, AJ, on finally getting your VA certificate of eligibility. Well deserved. Well deserved. Bailey, can I discuss the 1% conventional loan? I don't know a whole lot about it. But this is what I do know. Anything that has a low down payment or no PMI, no private mortgage insurance, you're typically going to have a great credit score. You're going to have some assets, and the interest rate is probably going to be a little bit higher than if you were bringing 3 or 5%. I've seen it. We don't offer it, but I just know from experience, if there's no down payment, the interest rate is going to be slightly higher. They're going to want good, as they call it, A paper, a good borrower who's got some assets, good credit score, low debt to income ratio. That's what I would know about it. I don't know specifically about that program, but that's my guess from my years of experience. SCW 377, does a judgment have to be paid in full to qualify for a mortgage? No, it does not. At a judgment, if you set up a payment arrangement and make 3 on-time payments, we can use that payment arrangement into your debt to income ratio and help you qualify. So it does not have to be paid in full. Wanda Payne, It says score range is 689 versus 720. The interest rate will be a big difference in the 700s. Not necessarily. So interest rate is one number, right? You can have a client that's got it. Let's say you've got a client that has a 689 credit score, and you've got a client that you say has a 720 credit score. They both may have the same interest rate, but what may be different is the cost of the interest rate, something called discount points. Discount points is 1% of the loan amount that it costs to get that particular interest rate. So while interest rates may not be rising or they may not change in that day, the cost to get that 6.5% interest rate or 7.25% interest rate may fluctuate throughout the day. So after 740 credit score, it doesn't matter. You're not going to get any better deal whether you got a 740 or 840. 689 to 720, the biggest difference probably will be the cost of that interest rate. Hopefully that helps, Wanda. Rodney says, what if the collections are more than 3 years old? No different. It's still showing as a collection. If it's on your credit report and it says collection, it can be 8 years old and it's the same rule. It may not be affecting your credit as much in terms of score, but in terms of us looking at it and it needed being addressed, then yeah, we have to either set up a payment arrangement, use 5% of the balance, or if it's pay it off. Now, paying it off typically paying off a collection does not increase your credit score. So that would be the last thing I would do. I would say, yeah, you could eventually pay it off, but I would use those funds for closing costs or to figure out how to increase my score with that same money. Hey, these are some great questions. Keep them coming, guys. Great questions. If you are just tuning in, we are talking about even if you have a major credit event, we can still get you approved. If you are new to the channel, do me a huge favor and subscribe or like. I'm here to answer your questions. Drop them in the chat. If you're watching the replay and you have a question, put them in the comment section. I do check my questions in the comments. Patrick Green, what about medical bills? Will that affect your opportunity to get a mortgage? And also, can your personal business help your credit? So yes and no. If you have a medical bill, it's not going to hurt your ability to get approved unless it is dragging down your credit score. So if it's dragging down your credit score, I would say call the collection company that has your medical bill. Ask them if they do something called a pay for deletion. And if they do a pay for deletion, make the payment, ask them for the deletion letter. Typically, they'll tell you it takes 30 to 45 days before they can have it removed from the credit agency. Unless it's a super huge medical bill, I'm gonna say $20,000-$30,000. That's the only way it may affect it, because at that point, with that amount of money, we just want to make sure that doesn't become a lien or a judgment. Your personal business help with your credit? I don't think I understand the question. If you have a business, does it help with your credit? Not necessarily, unless your business has personal credit cards. Unless you have personal credit cards that you're using for your business and you're paying on time or paying them off, yeah, it could affect it positively. But if you're a personal guarantor, it typically doesn't come on your credit until you defaulted. So that's probably the only way I can think of it affecting your credit. Malawi Lake, I think I said that right, and I remember you from before. Well, with a foreclosure, you have to wait 3 years, correct? Yes, for FHA 3 years, for conventional 7. Let's see. Hey, while we do this, guys, do me a huge favor. Like this video, put in your comments so we can answer your questions. It says, Rodney says, are there any law enforcement programs within an FHA mortgage loan? Typically, those programs are going to be location based. Like in Georgia, they have a program that is called Georgia Dream for Penn. Police, educators, doctors, nurses. And with that program, they will give you up to $12,500. Each area has something. They all have different names. Home for Heroes. It just all depends. But typically, there is something for first responders and law enforcement. It just depends on what part of the country you're in. Hopefully that answers your question, man. It says I had a 695 credit score, $1,500 in the bank, and had like a 1% DTI or less, no debt, $2,300 in collections. Lender couldn't get me approved for a Cal Dream program because of AUS decline. So what I will tell you, there are a lot of programs coming out. Conventional is very, very conservative. Very conservative. So if you had a 695 credit score, that's great. But your assets was probably the problem. Because think about it, in California, $1,500 won't even get you a rental. So if you had $1,500 in the bank, even though you were getting down payment assistance, they still want to see that you have some type of money. Because if you get in a jam, $1,500 isn't going to cover your mortgage, especially in California. Hopefully that helped, man. The Cal Dream program went away in a matter of days. I think it opened up on the 27th of March, and by April the 7th, all the funds were gone. I think it was like $300 million gone. So there was a need. So people are still buying. People are still buying homes no matter the rate or the price of housing, because rents are close to, I just seen somebody post in the comments, her rent is about what you would pay for a mortgage. So why not try to buy? Said Maui, he says, my mom had got about $12,000 first responder. Yep. So there's different programs out here, guys. While we're on that subject, even though this isn't part of the topic, with down payment assistance, there is no free money. There is some sort of attachment to those funds. So you're either going to have to stay in the house for a specific period of time. You're going to have to pay a higher interest rate. You may have to pay extra fees for closing costs or down payment, but there's something attached to it. I saw people comment on the Cal Dream program and said why they're so greedy. Why would they want to take 20% of my equity? Because they're partnering with you. If you didn't have that 20% that they gave you, you probably couldn't afford a home. So if somebody offered to pay 20%, and when I made money off of that, I only had to give them 20% back and I got to keep 80, I do it every day, all day. makes sense. That's why that $300 million went in a matter of 2 weeks or less. 2 weeks or less. Miss Eunice Williams says, if your credit is okay, but you have established business credit and it is in good standing, is it easier to buy a business property or a personal property, especially if you will be living in it? Great question. So if you are buying something considered as an investment property, you cannot live in it. An investment property is an investment property. If you're looking to get a rental property and you're using business credit, you should not be living in that property. Now, if you're going FHA and you buy a one to four family and you live in one of the units, that's not technically considered an investment property. It's considered your primary residence and you're just utilizing the other units as income to help you pay. That's perfectly fine. But if you came to me and said, hey, I want to buy an investment property in my business name using a DSCR loan, debt service coverage ratio loan, where you put 20% down, you shouldn't be living in that property because technically it's a primary residence. And why would you want to put 20% down on that? And when you do it, they typically pull your personal credit anyway. So then it has to be in your in an LLC or S corp, so some type of corporation. So I get it. We hear people talking about buying properties with their business credit, which is a great thing, but not to live in as your personal residence. And if you do, after some time, you want to switch the type of loan because investment loans cost more than regular primary residence loans. If it is a business downstairs but apartments upstairs, can you live in it? That is a great question, Miss Eunice. Yes. With FHA, you can purchase a mixed unit property as long as 51% of that property is residential. The other 49% is commercial. You live up top and you rent out rental space down the bottom. Yes, you can do that with FHA with 3.5% down payment. So that is possible. And you can do it in your primary residence name. That would make a lot of sense. If you can find that, that's a gold mine. That and 4 units, that's a gold mine. Rick said this is his last question. I don't know, Rick. Don't say that. I might need you for some more, brother. It says IRS processed my 2021 return where I owe. Since they don't show a balance owed, they won't do a payment arrangement. Can I still get an FHA loan? Process 20. So in their system, it's not showing that you have a balance. Because if in their system they don't show you have a balance, they have accepted your tax returns, they haven't processed it. Because typically when they process the tax returns, that's when they show the debt and they update your transcripts. When they received it, when they received it, that just means, hey, we've received your 2021 tax returns, but it hasn't been processed. Now, Rick, do me a favor, man. Reach out to me and let's set up an appointment because I can help you in California. Reach me at teamjefferson@summitfunding.net, or at the bottom is my Calendly link to book an appointment so we can talk. Is $25,000 in savings enough, not counting other assets, 401k, IRA, etc.? Yes, that's great. Depending on how much home you're looking to purchase, that could be enough. However, the fact that you have 401k and IRA makes it stronger, gives you a stronger case. So those are things that can be considered assets. So just to give you a hint, assets are money in checking savings, 401k, annuities, um, IRAs, any of that stuff can be considered assets, and it makes your profile stronger. No problem, Rick. So anything that you can do to make your profile stronger helps. Doesn't mean you have to necessarily use that money. That money is just if you are in a situation and you need some liquidity and you can go get some funds from there, then it just makes you stronger. It can be in all in one account, or it can be a mixture of things. Just looking at the total package of the borrower or borrowers. Guys, this is great. Again, if you're listening to this on the replay and you have a question, uh, drop the question below. If you are watching it in the replay, do me a huge favor, subscribe, give this video a thumbs up so the YouTube algorithm can push us out and we can get this great information out. Also, if you subscribe, it'll give you notifications. Hey guys, also, a lot of your names look familiar. If you're new, down below, you'll see a link to my Facebook group. Definitely join my Facebook group. I am going to be getting more active in that group. As a courtesy to you guys, I have a link below for a free home buyers guide that will walk you through the process. So definitely chime in, guys, and get that information. Also on the screen is my home buyers journal. My home buyers journal is a companion to the free home buyers guide. Now, the home buyers journal is $19.99 for the softback. I think $29 or $24.99 for the hardback. This is something that you can keep on for years to come. The home buyers journal will walk you through the home buying process and allow for you to take notes as you go along the process. So it has everything in there from a journal, not a journal, from a spec sheets on houses where you can take notes, information on the houses that you've seen, note sections just to take notes, period, on whatever you want to take notes on about your journey. There's budget sheets in there, sheets or information sections on how you can, questions to ask and who to ask on, who can be your realtor, who can be your lender. So like this book is 90 pages packed full of notes and information that can help you along your journey. And especially if you get the home buyers guide, they just complement each other. When you have a buyer's consultation with your realtor, you can take notes during that process. When you have a buyer's consultation or consultation with your lender, it can help you in the process as well. I think this is money well spent. And if you think someone who is looking to purchase a home, it could be a great gift for them as well. The home buyer's guide is free, walks you through the process of A to Z. You're still going to need a realtor. You're still going to need a lender. The home buying journal will help you journal your process as you go through it. So years down the road, if you forget, let's say you forget who your HOA is, or if you forget the square footage of the home or servicing things, you can always look back into that journal and say, okay, this is who did this. Or you could pass it on to the next homeowner and say, hey, here's some information that I took notes on 5-10 years ago when we purchased a home. This could be helpful. Barbara has a question. Do you have to show all bank statements or just your main account when applying for a mortgage? So we look for the bank account where your direct deposits go in, and we look for the bank statement that has your funds to close. So if you have a checking where your check goes into, and a savings where you're saving money for the home, we want both of those bank statements. If they're one in the same account, we just need that one account. I will tell you, because some banks link their checking and savings together, and people move money back and forth. It'll show on that checking account statement. So just provide both checking and saving. If your money isn't in the bank and you're going to utilize your 401k, provide your most recent 401k statement. If it's in an IRA, provide that. If it's an annuity, if you're selling stocks, you're selling bonds, we just need a paper trail. But that's a good question. Yeah, Miss Barbara and Miss Eunice, both of you asked the same question, just a different way. Hey guys, so I'm gonna take one more question and then I'm gonna wrap it up. Does anybody have any burning question that they want to ask me? Going once, going twice. All right, guys. So, hey, it has been great. I appreciate you guys hopping on with me. If you can do me a huge favor and share this, or share my channel with some of your friends, or someone you know that's looking to purchase a home, definitely do it. Again, if you're watching the replay, give us a huge thumbs up. Give us a huge thumbs up, and then subscribe to my channel. Hit the little notification button so you can get notified that you will be getting information on me when we get notified when we'll be putting out new videos. I'm sorry, I was reading Miss One's question. My thoughts about Fed now. Just a way for the government to control the money that we receive. So this is my thought, and I had this conversation with my wife. When 2023 came in, they were supposed to start issuing 1099s for money that you receive on Cash App, Zelle, Venmo, all of these payment sites. Well, what they found out was it was harder than they thought. So I think Fed now is for them to be able to control that and make it simpler for them to issue 1099s, because all of the money will now be funneled through them. I think that's their solution, so they can issue 1099s. My thoughts, I'm not a fan of those type of payment processing. They get hacked. But again, it's the government, so we just have to play with their system. That's my thoughts. I think it sucks, but what are we going to do? It's the government. Hopefully it gets shot down. Hopefully they'll do what they normally do, is not be able to agree on anything. So we'll see. Yeah. Well, hey guys, thank you for tuning in. I'm Kevin Jefferson, the People's Lender. Have a great day.